Do you need a quick refresher on taxation principles? You have come to the right place. You will find here a quick introduction to what you need to know about taxation, presented through accessible examples and case studies. This podcast explains the main features of UK tax, following the activities of Anna and Conrad, as they are trying to scale up their business. Anna and Conrad are inventors. They have come up with a novel door ring camera. They have manufactured a few of the cameras in Anna's workshop and now want to start selling them. They are thinking about the best way to go about building a business and would like to know more about tax implications of various forms of business organizations. This podcast has been prepared by Dr. ioannis.glinavos with the help of artificial intelligence tools. Get in touch with Ioannis by following the information on the description of this video to learn more about how the podcast was put together. Without further delay, let us get started on the content of this video, which focuses on elements of personal and corporate taxation in the UK. We will present how various choices in business organisation affect tax liability, and take our inventors Anna and Conrad through the tax implications of various organisational choices. Tax liability will be one of the key elements in deciding on organisational structures for carrying out business, as different forms of organization can have divergent outcomes in one's tax exposure. Optimizing business structures for tax purposes is something that will be at the forefront of entrepreneurial thinking as one sets out to create a business in the UK or invest in UK-based enterprises.
In the UK, the main provisions of income tax are present in the Income Tax Act of 2007. The basic position is that every individual with business activity, income from work or investment, will pay tax on their total taxable income each year. The income to be considered is what they have received through their activity minus any relevant allowances, deductions and reliefs as determined by HMRC. Remember that in the UK the tax year runs from April to April. It is not the same as the calendar year. Any tax liability will be accessed within this period. The sources of income for Anna and Conrad most likely will comprise of income received through salary, through pursuing their trade or profession, but also income received indirectly through interest on deposits and savings, dividend payments on shares and rental income from properties, real or movable. If one's income is derived solely through employment, HMRC will assess tax liability automatically through the information provided by one's employer, and income tax is deducted at source before one receives their monthly salary. This system is known as PAYE, which stands for Pay as You Earn. In the UK, therefore, employees receive in their bank accounts money they can use directly, and any deductions for tax, national insurance or pension contributions have already been taken in advance. Additional income not taxed in this fashion will need to be declared either directly to HMRC, so it passes on to the relevant pay code and taxed at source, or through a tax statement at the end of the tax year. Any unpaid income determined through a tax return will be then paid directly to HMRC or added to next year's tax code and withheld at source through pay as explained earlier. Remember that HMRC assesses one's taxable income. Not all income is taxable. For example, pension fund contributions are tax exempt. Therefore, if Anna earns £50,000 per year, but £6,000 of that are paid towards a future pension, then her taxable income will be £44,000. This applies to most private pension schemes, for example workplace pensions, personal and stakeholder pensions, overseas pension schemes that qualify for UK tax relief. Most pension funds in the UK are private and independent of state support. The government of the UK will set income tax rates for each year in the budget. There are several tax rates presented in bands. Those with taxable income below £125,140 benefit from a personal allowance of up to £12,570 on which they do not pay any tax at all. For April 2022 to 2023, for example, a basic rate of tax at 20% is deducted from income between £12,571 and £50,270. A higher rate of 40% is deducted from income between £50,271 and £150,000. Finally, there is an additional rate of 45% for income exceeding £150,000. Note that income tax deductions follow these bands. Anna and Conrad should not worry that once each person's income goes above, say £55,000, they will be liable to pay 40% tax on the total amount. This is a common misconception. The rationale for the bans is to make the income tax system progressive, taking a higher percentage from people who can afford it the most, as they have higher incomes overall. This can be contrasted with value-added tax, VAT, a regressive form of taxation, which burdens everyone the same way, regardless of their wealth generation in any given year. For your information, the rate of VAT in the UK in 2022 stood at 20% for most goods and services. The taxation of a business is primarily based on the form of business organization the entrepreneur has chosen to utilize. Going back to our earlier podcasts, you will remember that Anna and Conrad had a series of options available to them. They could operate their business in their personal capacity as sole traders, through a partnership or through an incorporated company. It is only the latter that offers tax treatment differential to the one for individuals, as described above. For sole traders and partners, the tax affairs of their business activity are not distinct from those of their personal ones. Specifically for partnerships, it is worth noting that as a partnership is not a separate legal person, for tax purposes it is treated as a group of individuals, a set of notional sole traders. The main distinction between business taxation for individuals and arrangements under pay is the treatment of business expenses. Only profits attract taxation, and in order to determine what these are, one has to separate income receipts generated from trading activities and deduct expenditure included in the process of preparing and delivering goods and services. Another distinction needs to be made between income generated through trading and capital receipts generated through the sale of fixed assets. There are different rates of tax for income and capital gains. In the UK, there is a different rate of tax on gains from residential property than on sales of other assets, and there is usually no tax when you sell your home. It is the buyer of the property that pays a tax, known as stamp duty. Basic rate taxpayer will pay tax depending on the size of gains, their taxable income, and whether any gain is from residential property or other assets. If this amount is within the basic income tax band, one will be asked to pay 10% on the gains, or 18% on residential property. For people above the basic tax band, the charge is 20%, or 28% on residential property, on any amount above the basic tax rate. It is worth noting that sole traders or partners will pay 10% if the gains qualify for business asset disposal relief. This covers the situation when one sells or disposes of all or part of their business. The rules through which trading income is determined and subjected to income tax are contained in the Income Tax, Trading and Other Income Act of 2005. Coming back to expenditure, we need to note that in order for any expenses to be deductible from income receipts, there must not be of a capital nature and they must have been fully undertaken for the purposes of the business. Examples include rent for business premises, salaries paid to employees, utility bills, local taxes, purchasing stock for sale, advertising costs and office equipment. Remember that accurate account keeping, within each tax year, is necessary in order for a business to be able to claim any allowances for expenditure. While these accounts do not have to fully audited, certain key pieces of information, creditors, debtors, work in progress, stock, must feature in them for HMRC to take them into account. If a business makes a trading loss, it will incur no income tax liability for the relevant tax year. Additionally, tax relief will be available in the form of a set-off against same and preceding year income. It is also possible for loss to be set against profits from the same trade in future years, to the extent that it has not been compensated already. There are also specific provisions to make this easier for businesses that are just starting out. For more information, see Section 72 of the Income Tax Act 2007. We will focus from now on the tax affairs of corporations, which will be most relevant to any business venture started or invested in by our pair of inventors Anna and Conrad. We will start by considering the tax liabilities of the corporate itself, before moving on to consider the position of those who invest in companies, as shareholders or through debt instruments. The main pieces of legislation as regards corporate taxation are the Corporation Tax Act of 2009 and the Corporation Tax Act of 2010. A company's taxable total profits subject to corporation tax are calculated by adding the amount chargeable to corporation tax on income after any applicable reliefs plus any amount in respect of chargeable gain after any applicable reliefs. This generates the total profits of the company. Any reliefs against income of chargeable gains are considered before calculation of the total profits, therefore reducing the amount. An example of what counts as a relief would be charitable donations. Then one deducts any amounts which CAB-NE relieved against the total profits to find the taxable total profits. You should remember that remuneration or rewards paid to a company's employees entitle it to a pre-tax deduction and reduce its taxable profits. This will include the payment of salaries, wages, pension contributions, or lump sum payments in compensation for dismissal. Employee benefits that can also be included could amount to company cars, meals, expense allowances, and so on. Employer national insurance contributions are also deducted from profits in the assessment of tax liability. The main type of profit that a company, such as the one envisaged by Anna and Conrad, will come from trading. How such profits are calculated depends on prevailing accounting practice, and legislation offers specific rules on how to calculate trade profits. The important thing is what counts as a deductible expense, usually expenses incurred wholly and exclusively for the purposes of the trade and losses that arise out of the trade. Companies will also be charged corporation tax on other forms of income, such as income from property, interest on loans, or financial assets and investments. Unlike individuals, corporations do not benefit from a personal allowance when calculating their tax exposure in any given year. The same goes for capital gains, whereby companies are not entitled to an annual exemption and do not benefit from most reliefs available to individuals. Companies will, however, benefit from an indexation allowance, not available to individuals, which removes any inflationary gains from tax charges. This brings us to the issue of assets that appreciate in value in general. If a disposal of an asset leads to an increase in company wealth, which in return causes shares to appreciate, the company may be concerned about double taxing of the same gains. Mechanisms such as the indexation allowance are introduced to deal with these types of issues. At Spring Budget 2021, the government announced an increase in the corporation tax main rate from 19% to 25% for companies with profits over £250,000, together with the introduction of a small profits rate of 19% with effect from the 1st of April 2023. The small profits rate will apply to companies with profits of not more than £50,000, with marginal relief available for profits up to £250,000. Corporation tax is normally payable 9 months after the end of the accounting period. However, larger companies, with profits exceeding £1.5 million, have to pay their taxes in installments on a tighter schedule. Where this happens, the company needs to estimate its tax liability and adjust payments accordingly, and any over or underpayments are subject to interest at the official rate. Trade losses are relieved in ways similar to those for unincorporated businesses that we discussed earlier. A company may settle a loss made during a tax year against future tax liabilities. This can happen for trade losses or capital losses. There are also some provisions for some relief for losses allocated within group structures between parent and subsidiary companies. Anna and Conrad will be able to benefit from participation in a company either through their status as employees or through their status as investors through shareholding, meaning via the payment of dividends on the shares. What should be understood is that choosing to incorporate means that there will be a fundamental and legally enforced distinction between company and personal finances. Our two entrepreneurs therefore will not be in a position to extract wealth from their business, unless this is formalized, with the two methods mentioned earlier being the most common ways to participate in corporate wealth creation. The tax implication of these facts is that apart from the tax affairs and liabilities of the company, Anna and Conrad will incur personal liability for any earnings they extract from the business. Depending on the personal position, there may be some benefits in one method, for example capital gains, over another, for example wages, but there is no automatic tax benefit that applies without context. Therefore, the commonly held view that engaging in business through a corporate brings immediate tax benefits tends to be erroneous. See the discussion on personal liability at the beginning of the lecture. Employee benefits, beyond the payment of salaries and bonuses, are also subject to tax at the personal level. For example, if Anna Con Limited rents a property for £8,000 per year to provide accommodation to Anna and Conrad, for which they pay £4,000 a year, they will receive a taxable benefit of £4,000, which they will need to declare in their self-assessment tax statements. Also, any money offered for expenses that have not actually been spent for the purposes of employment will become taxable. For example, if Anna receives £100 per month for expenses, but only spends £80, the remaining £20 will be taxable. Note that a company is not allowed to avoid paying management costs and the payment of employers' national insurance and pension contributions by offering work to its personnel as contracts and paying them on a contract basis. This is covered by the rules, this are quite controversial, on IR 35. HMRC will deem attempts to circumvent an employer-employee relationship as violations, and the company will become liable to contributions in the normal way. The consequence for personnel of tax-efficient arrangements is that employment law rights may be affected regardless, so Anna and Conrad should consider carefully not only the tax implications of various arrangements, but also their personal interests and protections as employees as opposed to contractors. If Anna and Conrad receive benefits from their participation in the company in the form of dividends on shares, they will be liable to income tax. These payments include any dividend paid by the company, distribution of additional shares, in some cases, and any interest paid on securities, financial assets, where the interest paid is dependent on the profits of the company. For the avoidance of doubt, the payment of dividends does not reduce the company's liability towards corporation tax. Individuals in receipt of dividend payments are subject to different tax rates than the ones applicable to the rest of their income. As of April 2022, the dividend ordinary rate, for base rate taxpayers, is set at 8.75%. The dividend upper rate, for income up to £150,000, is set at 33.75%, and the dividend additional rate, for income above £150,000, is set at 39.35%. Any individual who has dividend income can benefit from the dividend allowance, which has been set at £2,000. Dividends within the allowance are not charged any tax. If Anna and Conrad live in France, but engage in business in the UK, they will still need to consider the tax implications of their UK-based activities. Non-UK tax residents are still liable to pay income tax on income derived from activity in the UK. They may also be liable to capital gains tax for the sale of assets, including, but not limited to, residential properties. Whether one has tax residency in the UK will depend on the outcome of a statutory residence test, which contains a series of questions about each person's links with the UK and the time they spend in the country, either for work or otherwise, that help determine tax residency. Even Anna and Conrad are determined to be not resident in the UK for tax. They may still have to fill in a tax return if they are directors of their company and receive payment for their duties, if they derive income from real estate, or if they sell property of other assets liable to capital gains tax. In order to file a tax statement, one needs to contact HMRC before October each year to declare income received during the prior tax year. Failing to declare taxable income to HMRC attracts penalties and fines that increase the longer the delay is. What Anna and Conrad will be most concerned about is the possibility that they may be taxed twice for the same income in the UK and back home in France. Choosing where to be taxed to take advantage of any lower rates is not really the issue in this context, as we are considering actual activity taking place in the UK, as opposed to a scheme for tax optimization. It is important to note, however, that one can only benefit from tax allowances and exemptions only in their country of origin. Anna and Conrad could not claim both exemption from tax for their initial income in France and claim their personal allowance in the UK at the same time. They will need to make a choice, and if they can genuinely choose where to locate for tax purposes, whether one regime is more beneficial than the other will certainly affect the decision. Generally, if someone lives in one country and are a member of the management board of a company in another, the country where the company is located may tax fees and income related to this role. Most countries will treat as part of taxable items any benefits in kind, for instance stock options or company car, that one receives as a board member. If, alongside a role as a board member, one works for the same company as an advisor, a consultant, or an ordinary employee, income from these functions will most likely be subject to the same tax treatment as that applied to cross-border commuters. A cross-border commuter is someone who lives in one country and works in another. The taxation rules applicable to income will depend on national laws and double tax agreements between these two countries, and rules can differ considerably from those that determine which country is in charge of social security issues. Depending on the applicable double tax agreement, one may have to pay taxes in the country of work as well as in their country of residence. If one is an employee, the country where they work will, in most cases, tax the income earned on its territory. If one is self-employed and registered as such in the country where they live but provide services across the border, they will generally have to pay income tax in the country where they provide services if they set up a fixed base or permanent establishment, such as an office or a shop, there. If one lives in one EU country but earns all or almost all of their income in another and pay tax there, the country where the income is earned should treat them as it would treat a resident. That is, it should offer the same tax reliefs and tax exemptions and any other tax benefits available to residents, such as personal allowances, or the possibility to complete a joint tax return with a spouse. Brexit has complicated the position of foreigners engaged in business activity in the UK both for immigration purposes, right to work, and in terms of tax exposure. The tax treatment of interest, royalty and dividend payments from the EU to the UK post-Brexit is dependent upon the domestic law of the source country and the relevant tax treaty between that country and the UK. Although the UK has an extensive treaty network, some treaties including those with Italy, Portugal and Germany offer a less favourable outcome than has been the case under the EU directives. Luckily, France and the UK have a treaty for the avoidance of double taxation and for cooperation in issues of tax. The treaty specifies that the industrial or commercial profits of a United Kingdom enterprise shall not be subject to French tax unless the enterprise carries on a trade or business in France through a permanent establishment situated therein. If it carries on a trade or business as aforesaid, tax may be imposed on those profits by France, but only on so much of them as is attributable to that permanent establishment. An individual who is a resident of the United Kingdom shall be exempt from French tax on profits or remuneration in respect of personal, including professional, services performed within France in any year of assessment if they are present within France for a period or periods not exceeding in the aggregate 183 days during that year, and the services are performed for or on behalf of a resident of the United Kingdom, and the profits or remuneration are subject to United Kingdom tax.
We now move on to issues relevant to international taxation regimes, payments and efforts to combat money laundering. We start with a presentation of the evolution of a system of global cooperation on tax issues. This is significant even for small to medium-sized investors. We then explain the operation of payment systems, especially as they relate to international money transfers. This issue leads to a necessary discussion on measures to prevent money laundering, as these have become pervasive requirements for anyone involved in finance and commerce.
International tax law is a term that can be used to describe the rules and principles that together regulate the taxation consequences for individuals and businesses that enter cross-border transactions. There is no universal tax law jurisdiction or all-encompassing set of rules, however, and the rules and principles that many nation-states apply when drafting their domestic rules and negotiating their many double taxation agreements are part of each nation-state's domestic tax regime. Countries are constrained by the international tax rules they adopt, and there is a network of over 2,000 bilateral tax treaties that contain definable principles that underlie the treaties and are common to many of them. There is also growing cooperation and coordination of tax policies and rules across countries with disparate tax systems. The OECD, Organization for Economic Cooperation and Development, and the OECD, G20 have had a great influence on international tax law by preparing a model double tax convention, MTC, that they agreed to adopt. This has been supplemented by work by the OECD, G20 on the issue of base erosion and profit shifting, BEPS. This was the problem of companies shifting profits to countries where they would be taxed more lightly. This initiative now constitutes soft law in that it is not legally binding. However, there is an expectation that the BEPS outputs will be implemented by those countries that participate in the process. There are 4 minimum standards: preventing treaty shopping, country-by-country reporting, fighting harmful tax competition and improving dispute resolution, contained within the BEPS actions, and together these constitute areas where all OECD, G20 countries have committed act. Other areas considered in the BEPS actions, such as hybrid mismatch arrangements and best practice in interest deductibility, have resulted in countries agreeing to act in a similar general policy direction as opposed to agreeing to a baseline standard. The OECD anticipates that over time the tax regimes of countries will begin to converge in relation to these more general policy areas, and that it is possible that these areas may then also constitute minimum standards. As each nation-state determines its own tax regime, the movement of people and investment across borders creates the potential for taxable amounts to fall within the tax reach of only one nation-state, within the tax reach of 2 or more nation-states, or outside of the tax reach of any nation-state. These 3 basic scenarios create problems for nation-states that international cooperation seeks to address. The principles of equity, economic efficiency and simplicity, which include administrative convenience, are often cited as the 3 major principles that should guide tax policy. These principles are difficult to define and are best regarded as starting points for the discussion of the nature of a tax and providing criteria to judge whether a tax is effective. Equity requires that taxes are levied fairly across society. This notion of society has traditionally envisaged a national society. Ability to pay is often referenced as a measure of the equity of a tax or tax regime. Generally, it has focused on horizontal equity. Taxpayers in similar situations should receive similar tax treatment, i.e., taxpayers that derive the same amount of income should be taxed in the same way, and vertical equity. Taxpayers should be separated according to their level of income, with the result that taxpayers in different situations should be treated differently, i.e., progressive taxation. Economic efficiency requires that tax is imposed in a manner that least interferes with wealth creation. Traditionally, neutrality was a virtue to be aspired to. Taxes should try not to interfere with commercial decisions. The perfect market hypothesis stipulates that markets, left to themselves, bring about optimally efficient outcomes. There are, however, numerous examples of taxes that seek to encourage, e.g., research and development tax credits, or discourage, environmental taxes, certain types of behavior or activity. In contradistinction to neutrality, where markets are shown to fail, taxes can perform a regulatory function whereby they can neutralize or correct negative externalities. Simplicity is a derivative principle that includes several other sensible ideas, such as comprehensibility, visibility, transparency, certainty, effectiveness, coherency, consistency, and administrative convenience. Administrative convenience requires that taxpayers are subject to rules that are easy to understand and apply, and that governments bring in rules that can be implemented with as little waste of resources as possible. There is no perfect tax. A tax may be equitable between taxpayers but require much public administration. Another tax may be easy to collect but is not transparent and may be regressive. Taxes are often classified into various categories based on their nature or the object of their focus, e.g., gift taxes attached to transfer of gifts from one person to another. References to international tax in this course are references to taxes on income and on capital gains. In terms of the need to ensure that inbound and outbound investment decisions are not negatively affected by domestic tax rules, a good example of a restricted form of tax sovereignty is evidenced by the European Union, EU. Although the EU provides a good example of constraints placed on tax sovereignty, governments around the world recognize that in a globalized world where both people and capital are highly mobile, it is difficult, if not impossible, simultaneously to ensure capital is invested efficiently in their economies, and ensure they receive a fair proportion of the tax due on overseas placement of its subjects and their investments. It can be said that governments have been ceding their tax sovereignty on a case-by-case basis or need-to-cede basis. In effect, this means that wherever the potential advantages of ceding an aspect of tax sovereignty outweighs the disadvantages of ceding that aspect of tax sovereignty, governments determine that such a ceding is worthwhile and vice versa. The term jurisdiction to tax refers to the tax reach of a given nation-state. In other words, the extent to which a nation-state includes amounts of income in its tax base when these amounts cross jurisdictional or territorial borders. In relation to direct taxation, traditionally there has been agreement surrounding some fundamental aspects of the nature of the jurisdiction to tax. This agreement involves a nation-state being able to include within its tax base certain types of income without reproach from other nation-states. Specifically, this means the acceptance that other nation-states will include the following within their tax base: income of persons who are residents of their state, irrespective of the location of the source of that income. Income of persons who are not residents of their nation-states but who are present or do business in their nation-state where that income is derived from activity or investment in their nation-state. The existence of an agreed core set of principles relating to the jurisdictional extension of a nation-state's tax reach has provided some certainty for taxpayers and governments alike. These principles can be described as connecting factors in that a person, an activity, some property or an amount of income is considered to have some form of connection with a particular state. The connection must be sufficiently strong to justify an assertion of their jurisdiction to tax in one of the three categories. However, different states have different rules as to the various connecting factors. For example, an individual may be regarded under UK law as being resident and thus taxable in the UK but simultaneously resident and thus taxable in Greece. These rules are not coordinated. Thus, there is potential for more than one state to assert its jurisdiction to tax over an amount of income falling within one of the above categories, jurisdictional overlap. There is also potential for two or more sets of domestic rules to operate in such a way that an amount of income falls outside the above categories, jurisdictional vacuum. This is primarily because although there is agreement that states may assert their jurisdiction to tax in relation to the above three categories of income, there is no requirement that nation-states adopt rules in this way. In other words, there is no formal requirement of a minimum level of taxation. This means that it is possible that certain amounts of income that cross national borders may escape taxation altogether. A further related concern arises from the fact that even when the appropriate principles are applied in a context involving two or more states, the principles may operate in such a way as to disadvantage one state over another. For example, nation-states have different levels of economic strength, and where two or more nation-states determine to divide up the tax take relating to income that arises because of international activity, there is the potential for the stronger or wealthier nation-state to resolve to reduce the instances of double taxation in such a way that works to its advantage but to the disadvantage of the other nation-state. This jurisdictional imbalance forms the basis of the notion of inter-nation inequity, where, for example, two or more nation-states assert their jurisdiction to tax in a manner consistent with the above-mentioned principles. Taxpayers who satisfy one or more of the principles in more than one jurisdiction may be subject to the claims of more than one jurisdiction. Let's consider the following example. If Anna is a resident under the tax law of Greece and works as a consultant, she is contracted to supervise a project in the UK. Imagine Anna earns €50,000 in Greece and €25,000 in the UK. If Greece subjects to tax all the income of its residents, wherever that income arises, Anna will be taxed on her total income of €75,000. If the UK taxes all income derived in its jurisdiction irrespective of the residence of the person that derives the income, Anna would be liable to tax on €25,000 in the UK. The effect of this for Anna is that she must pay tax on the €25,000 in both Greece and the UK. If Anna had earned the additional €25,000 in Greece, as opposed to the UK, she would only have been subject to tax on that €25,000 in Greece. Accordingly, by working in the UK, Anna is worse off. This is referred to as juridical double taxation. Both countries consider that they have jurisdiction to tax Anna's €25,000. Greece considers that it can tax the €25,000 as Anna is a resident and subject to tax on a worldwide basis, and the UK considers it can tax the €25,000 as the income has a UK source. We are assuming here no tax cooperation between the two countries. By changing the facts, we can see that Anna could be in an even more onerous position with respect to jurisdictional overlap. Imagine that the rules as to what constitutes residence differ in Greece and the UK. As a result, Anna is treated by both countries as being a resident under their domestic law. This could be because Anna spends a long time working in London but has her home in Athens. Also imagine that both countries use the worldwide basis of taxation. If Anna is treated as being a resident in both countries and because both countries use a worldwide basis of taxation, Anna is subject to taxation on the full €75,000 in both countries. This is potentially a very onerous position, and again Anna is potentially worse off because she has decided to travel overseas, stay there and work. Of course, inconsistencies in tax rules can also present opportunities for taxpayers. A real-life example was Italy in the 1970s. Italian companies were taxed according to their place of incorporation, while in the UK companies were taxed where their central management and control was cited. Accordingly, Italian companies would incorporate in the UK but control their companies from Italy. In this way, they managed to avoid tax in both the UK and Italy. Both the UK and Italy changed their laws to address this problem. The cases of multinational companies such as Apple, Google and Amazon have brought this ability to fall within a jurisdictional tax vacuum to the public attention in the modern context. We will see throughout the course that the issue of jurisdictional vacuum has become so well publicized that both governments around the world and supranational organizations such as the OECD have seen fit to focus significant resources and time on ensuring that taxpayers engaged in cross-border activity have fewer and fewer opportunities to operate within a jurisdictional vacuum. This is particularly true of the G20 and OECD's base erosion and profit shifting initiatives. Recently, there has been an increased focus on the desperate need for there to be not only a fair amount of tax paid by international operators overall, but also that nation-states with weaker economies need to ensure that they are not being deprived of their fair share of tax revenue. This issue has recently received more attention due to the recognition that nation-states with weaker economies desperately need to be able to generate their own revenue to ensure their continued development, and all nation-states are seeking to protect their taxes post the global financial crisis. In particular, the concept of double taxation emerged through the work of the OECD, G20 in relation to hybrid mismatches. Hybrid mismatches involve arrangements that exploit differences in the tax treatment of instruments, entities, and transfers between two or more countries, e.g., hybrid entities, dual residence companies, and hybrid instruments and transfers. The OECD has focused on instances of unintended double non-taxation, i.e., where countries do not intentionally structure their tax systems in a way that results in no tax liability. These instances exclude situations where the relevant country has determined to provide for special tax concessions, such as tax-exempt savings vehicles or a specified personal allowance. Nation-states frequently use similar types of connecting factors to demarcate their jurisdiction to tax. States adopt rules that assert their jurisdiction to tax in relation to a personal attachment to a particular nation-state, nationality, and to an economic attachment to a particular nation-state, origin or source of income generation. The adoption of these types of principles by different nation-states can result in suboptimal situations for both taxpayers and governments alike. Many countries incorporate methods of relief from double taxation in the domestic tax regimes, which does away with the need to allocate the rights to tax amounts to one nation-state or another. However, there is also a large network of double tax agreements, DTAs, which are treaties entered into by two nation-states that allocate the rights to tax certain amounts in a legally binding context. When we talk about allocating taxing jurisdiction, we necessarily must consider a scenario with more than one nation-state in which a taxpayer who is considered to have sufficient connecting factors with more than one of those nation-states is subject to taxation under both nation-states' domestic tax regimes. When this happens, the allocation of taxing jurisdiction function of the DTA looks to the type of income generated by the person and considers which nation-state has the primary right to tax the income, primary jurisdiction to tax, and which has the secondary right to tax the income, secondary jurisdiction to tax. From a practical perspective, it is difficult for a nation-state to assert an unlimited jurisdiction to tax in an overseas context, because it does not have the ability to collect tax when the taxpayer is overseas or because it does not have information about the activity taking place outside of its jurisdiction. There also can be issues in a bankruptcy or liquidation where one of the creditors is a fiscal authority. In these circumstances, the courts will allow the proceedings to continue, as to stop them would be to prejudice the ordinary creditors. Primary jurisdiction to tax is asserted by a nation when it claims the right to tax income irrespective of the jurisdictional claims of other nations. Obviously, if double taxation is to be avoided, each instance of income should be subject to the primary jurisdiction of only one nation-state. A claim of primary tax jurisdiction involves a nation-state asserting its economic connection with the relevant taxable amount of income and so asserting its primary right to tax that amount. Such a situation may or may not result in double taxation. Economic relationship-based claims are treated as primary, as the claiming state, i.e., source state, will be in a stronger position to assert its jurisdiction to tax than another state which has, for example, a personal connection with the same taxable amount. The principle that expresses this economic connection is referred to as the source principle. In other words, where a nation-state can demonstrate that an amount of income originated within its national borders, then it can claim taxing jurisdiction over the relevant amount because the amount has a source within its national borders. Secondary jurisdiction is claimed by a nation when it asserts the right to tax a person that falls within its definition of resident for tax purposes but allows the taxpayer a foreign tax credit to the extent that the income in question is taxed by another nation based on an economic relationship. Personal relationship-based claims are treated as secondary. The state that can claim a taxable amount is personally connected with its jurisdiction will be in a weaker position when asserting its jurisdiction to tax than another nation-state which has an economic connection with the same taxable income. Once our inventors, Anna and Conrad, get going with the production of their water sprinklers and engage in commercial activity, how will the earnings reach them? Any commercial transaction will have two objectives: the supply of goods or services and the payment for those. Payment must be made in the way stipulated by the contract. This will often be in money or via a check. If payment is agreed to be made by check, it is only complete when the check is honored by the payer's bank. Until that time, payment is conditional and the duty to pay will revive if the check is not honored. The main issue therefore will be what method of payment do the parties prefer. If the customer wishes to use another method from the one expected by Anna and Conrad, it will not be effective unless ratified by them. The transfer of money can be undertaken in several different ways. The most familiar method is by the physical delivery of cash to the seller of the goods. The transfer of money can also be undertaken by the physical delivery of a negotiable instrument, such as a check or bill of exchange, to the seller. This may involve some formalities, such as endorsement. The holder of a negotiable instrument obtains good title if they have given value and had no notice of any defects in the title of the person delivering the instrument. Remember that a negotiable instrument is not money, rather it constitutes an entitlement to demand payment from another party. Note that in the UK most checks are crossed, account payee, and are not transferable and, therefore, not negotiable, but are valid only between the parties to the check. It is more likely, however, that payment will be made by a direct transfer from the customer's bank to the seller's bank. The main methods of interbank transfer in the UK are CHAPS, Clearinghouse Automated Payment System, for high-value electronic credit transfers, BACS, Bankers Automated Clearing System, for low-value electronic debit and credit transfers and faster payments, with SWIFT, Society for Worldwide Interbank Financial Telecommunications, being the norm for cross-border transactions worldwide, and SEPA, Single Euro Payments Area, in euros. SEPA operates under Target, Trans-European Automated Real-Time Gross Settlement Express Target System, run by the European Central Bank and facilitates euro transfers. The main UK clearing systems, which, although separate companies, operate under the Association for Payment Clearing Systems, APACS. There are other non-APACS clearing systems, most notably those operated by the Visa and MasterCard credit card providers. Cheque bank transfer should be the most secure method, although no method is entirely safe from fraud. Where there is a funds transfer, the order by the customer to their bank to make the payment does not give rise to a right of the seller against the customer's bank if the bank fails to observe the customer's mandate. The payment by the customer's bank to the seller will discharge the debt owed by the customer to the seller because it is made on the authority of the customer. A payment, even if routed through banking channels, requires an authorized acceptance by or on behalf of the seller before it is complete. Where payment is made through a bank, it will be achieved by an adjustment of the balance of the account of the customer, in this case, which is debited, and of the seller of the goods, which is credited. This process is initiated by the payer issuing an instruction, which the bank, normally, must observe. The debt owed by the bank to the customer is reduced, unless the account is overdrawn, in which case the customer's liability to the bank is increased, and the debt owed to the seller increased, or, if the account was overdrawn, the seller's liability is reduced. The payment by the bank discharges the debt owed by the customer to the seller. Neither credit transfers nor debit transfers are negotiable instruments, apart from checks, but even a check will not normally be negotiable. Bills of Exchange Act 1882. The mechanism for effecting a bank transfer can be illustrated as follows. Xenon Bank makes a payment of £100 in cash or by cheque or other form of funds transferred to Yardle Bank. Xenon and Yardle will both have accounts at the Bank of England, the UK's central bank, so an instruction can be issued by Xenon to debit its account at the Bank of England and credit Yardle's account with £100. It could also be that Xenon and Yardle both have accounts with another commercial bank and agree to settle through that bank. A payment in a foreign currency will usually pass through the central bank of the relevant country, even if the payer and payee are not in the country. For example, a payment in US dollars by a customer in Athens to a seller in London will normally be settled at the Federal Reserve Bank of New York. It is likely that Xenon and Yardle will have several payments between them because they will have a large number of customers, so the payments due to Yardle from Xenon will be set off against the payments due from Xenon to Yardle and the balance debited and credited through accounts at the Bank of England. Settlement may be either on the day the payment is made, same-day funds, or the following day, next-day funds. Some methods of transfer restrict netting. CHAPS, Clearinghouse Automated Payment System, for instance, is designed to achieve rapid payment, so payment is made gross, although where there is a queue of payments in the system it may be possible to net them. As has been mentioned, net settlement may be bilateral or multilateral. In bilateral netting, settlement is between the two banks. Multilateral netting is a system of pooling the debits and credits of several banks. It involves totaling these and reaching a conclusion in which each bank will either be a net debtor or net creditor, or expressing its net position as a plus or minus figure. When the net position of each bank is determined, each transfers into, or receives from, the settlement agent that figure. Despite the sophistication of IT systems and the interconnection of the banking systems, there are still some risks with these transfers one needs to be aware of. If Xenon receives a payment instruction from Yardle for Anna's account, Xenon credits Anna's account and Anna issues an instruction to pay this amount to Conrad at Zoran Bank. If a problem in the settlement system occurs that means Xenon, which is a net creditor at the end of the settlement period, does not receive funds, e.g., because of the failure of Yardle, Zenon will be in difficulty. The problem can be multiplied if Conrad has paid the funds on to other people. Attempts are made by settlement rules to reduce these risks by, for instance, monitoring balances, requiring same-day settlement or placing limits on credit and debit positions of banks, or by switching certain large payments to a real-time gross settlement. Where there is insolvency, the principle of mutuality in insolvency law means that set-off can only be exercised in respect of debts between the same counterparties. This means that the liquidator of an insolvent bank can challenge multilateral netting to the extent that it attempts to set off obligations not entered by the insolvent bank itself. This rule cannot be evaded by an agreement between the parties because such agreements are void for public policy insofar as they avoid the consequences of insolvency law. Settlement will involve a clearing process. While settlement involves payment of funds, clearing is how banks exchange payment instructions. Clearing can be bilateral, between two banks, or, more likely, multilateral, between banks that are members of a clearing system. The clearing system is operated by a clearinghouse. It will deal with paper instructions, e.g., checks, giro transfers, which will involve the physical passing of the paper instruction to the bank on which it is drawn, or, in practice, the clearing department of that bank, and/or electronic instructions, which will be passed electronically through telecommunications links and computers. Different clearing systems have been established to deal with different types of payment instruction. In the UK, banks that are members of the clearing system are called clearing banks, and those that are not members, including overseas banks, will have an arrangement whereby they can pass and receive payment instructions through a clearing bank. If a customer opens an account of a kind which is of a kind into which CHAPS transfers can be made, that customer is entitled to assume that, if a transfer is made for the credit of that account, the bank will operate the account in accordance with the CHAPS rules. Money laundering is the process by which criminally obtained money or other assets, criminal property, are exchanged for clean money or assets with no obvious link to their criminal origins. Money laundering can take many forms, such as handling the proceeds of crime, being directly involved with any criminal or terrorist property, entering arrangements to facilitate the laundering of criminal or terrorist property, investing the proceeds of crime into other financial products or into the acquisition of property and assets. The main UK legislation covering anti-money laundering is the Proceeds of Crime Act 2002 and the Money Laundering, Terrorist Financing and Transfer of Funds, Information on the Payer, Regulations 2017. The Proceeds of Crime Act 2002 sets out the primary offences related to money laundering: concealing, disguising, converting, transferring or removing criminal property from the UK, entering into or becoming involved in an arrangement that facilitates the acquisition, retention, use or control of criminal property by or on behalf of another person, the acquisition, use and/or possession of criminal property, failing to disclose knowledge or suspicion of money laundering to either the nominated officer, where relevant, or the National Crime Agency, tipping off any person that such a disclosure has been made. For the purposes of these offences, criminal property means property of all forms, including, of course, money, which constitutes or represents, in whole or in part, directly or indirectly, a person's benefit from criminal conduct. Criminal conduct is conduct which constitutes an offence in any part of the UK or would do so if the conduct occurred in the UK. If a person obtains what is referred to as a pecuniary advantage, because of or in connection with criminal conduct, they are treated as having obtained a benefit because of or in connection with that criminal conduct. In other words, it is not necessary for a person actively to receive proceeds from an offence for their assets to constitute or represent the benefit of criminal conduct. The savings that a person makes because of tax evasion are, therefore, treated as criminal property, albeit perhaps without there being any specifically identifiable proceeds from that criminal conduct. A person commits an offence if they conceal, disguise, convert or transfer criminal property, or remove criminal property from the UK. Concealing or disguising criminal property includes concealing or disguising its nature, source, location, disposition, movement, ownership or any rights connected with it. The offender must know or suspect that the criminal property represents a benefit from criminal conduct. The prosecution can also rely on circumstantial evidence from which a jury can draw inferences that the defendant had the necessary knowledge or suspicion. It is necessary therefore to prove a. The act of concealing, disguising, etc. b. in relation to property, c. which was a benefit from criminal conduct, and d. that the defendant knew or suspected that the property represented a benefit from criminal conduct. A person commits an offense if they enter into or become concerned in an arrangement which they know or suspect facilitates the acquisition, retention, use or control of criminal property by or on behalf of another person. To establish a conviction, the prosecution must prove not only that the defendant became concerned in an arrangement which they knew or suspected would make it simpler for another person to acquire, retain, use or control criminal property, but also that the defendant knew or suspected that the property constituted or represented benefit from criminal conduct. The test is whether the arrangement has the effect of facilitating the acquisition, retention, use or control of criminal property by or on behalf of another person. A person commits an offense if they use criminal property or, passively, possess criminal property. This crime is presumably intended to apply to persons who are not necessarily involved in the underlying criminal conduct or subsequent laundering activities, but nonetheless knowingly enjoy the benefits of criminal activity. The prosecution has to prove acquisition, use or possession of property, which was the benefit of criminal conduct, that the defendant had the necessary knowledge or suspicion that the property represented a benefit from criminal conduct. A person will have a defense to the money laundering offenses if they make an authorized disclosure prior to the offense being committed and them gaining appropriate consent intend to make an authorized disclosure, but had a reasonable excuse for not doing so, knew or believed that the money laundering was being committed in another jurisdiction and, at the time it occurred, such conduct was lawful under the criminal law then applying in that country or territory. In addition, a person will also have a defense under if they receive adequate consideration for the criminal property. A person commits an offense if they know or suspect, or have reasonable grounds for knowing or suspecting, that another person is engaged in money laundering. The information on which their suspicion is based comes in the course of business in the regulated sector. They fail to disclose that knowledge or suspicion, or reasonable grounds for suspicion, as soon as practicable. Broadly, the regulated sector activities that are covered are accepting deposits, insurance, dealing in investments as principal or agent, arranging deals or investments, managing investments, safeguarding and administering investments, sending dematerialized instructions, establishing collective investment schemes, advising on investments and issuing electronic money. A person does not commit an offense under if they have a reasonable excuse for not disclosing the information, or a professional legal advisor and the information or other matter came to them in privileged circumstances. But notably, this defense does not apply if the information is communicated with the intention of furthering a criminal purpose. They do not know or suspect that another person is engaged in money laundering, have not been provided by their employer with such training as is specified by the Secretary of State, knew or believed that the money laundering was being committed in another jurisdiction and, at the time it occurred, such conduct was lawful under the criminal law then applying in that country or territory. Notably, legislation uses an objective test and thereby effectively criminalizes negligence in the regulated sector. Thus, if an individual employed in the regulated sector fails to detect or suspect that a suspicious person is engaged in money laundering activities, but, then, a court determines that objectively, in the given circumstances, they should have done so, that individual, and consequently the firm, may be guilty of a criminal offense punishable by a fine and up to 5 years imprisonment.
In this podcast, we focused on elements of personal and corporate taxation in the UK. We presented how various choices in business organization affect tax liability and take our inventors Anna and Conrad through the tax implications of various organizational choices. We started off with an overview of UK tax for individuals, reviewed the tax implications of various types of business organizations, and spent some time concentrating on corporate tax affairs. We then considered the tax liabilities of company personnel, and discussed the position of foreign entities operating in the UK in terms of tax. We finished with a reflection on tax cooperation between France and the UK, and provisions for the avoidance of double taxation. We then moved on to consider a series of issues relating to taxation and international money transfers, starting with the evolution of a system of global cooperation on tax issues. We explained the operation of payment systems, especially as they relate to international money transfers. This led to a necessary discussion on measures to prevent money laundering, as these have become pervasive requirements for anyone involved in finance and commerce. Thank you for listening till the end of this podcast. Feel free to subscribe to the channel and click on one of the links on your screen for more in this series.